Hi, I'm Jim Yant from Golden Years Advisors, the home of the Kairos formula. Well, happy Cinco de Mayo. We hope you're having some chips and salsa and maybe sipping on a margarita. A lot has been happening in the market, the economy, and the world. So we thought it was time to do an update. So we're going to do our May update. And we're going to start by having a series of videos. The first one will be on the speedometers as well as an economic outlook. We're going to talk about the Fed tightening campaign, what they're doing with interest rates, the whole banking situation that's going on that's scaring a lot of investors, the debt ceiling, the demise of the dollar. Is the dollar still going to be the reserve currency? And then what does that mean from a portfolio perspective? So we're going to do multiple of these videos. Here's number one. Let's get into it. So we haven't done a speedometer update from our good friends at City National Rockdale in a while. Just to remind you, green is a positive thing for the markets and the economy. Looking forward on a 6 to 9 month basis. As you can see, there's no green on the screen. Instead, we have 13 yellows. Yellows don't mean caution. I know that's what it means in our brain, but it just means neutral. And then we have 7 red items, which is negative. So of the yellows, just a comment I'll make, is especially when they're kind of at the 12 o'clock position, that's really neutral. But as they tick further to the left, like over here, the US economy is slowing down. That'll be one of the main things we'll be talking about in these video updates. Then it's getting closer and closer to the red. But here's the changes from last time. Fiscal policy got worse. That's all about the debt ceiling. We're going to do a video just on that. Another one that actually improved was inflation. We're making progress on inflation. I'll show you that in just a slide. But otherwise, our 7 items, the things that are really negative is monetary policy, because interest rates are so high. The yield curve is inverted, excuse me. Interest rates are, we spiked 5 percentage points in under a year. That's a big deal. Our leading economic indicators have been negative for about 8 months. The international economic outlook is far worse than on the US. And credit demand, because of that banking crisis, last month, not this month, slipped into the red zone. So I said we're winning the war on inflation, and we definitely are. Here's CPI, Consumer Price Index. And if you look back, red is the headline number, which includes energy and food. And, we peaked right in that 9% range and have since fallen dramatically, made a lot of headway. We're down to 5%. The core is when we subtract out food and energy, and it too has come down, but it's actually right now higher than core. And so we'll see how that goes going forward. That's what most of us use, the CPI, but the Federal Reserve uses this indicator, the personal consumption expenditure and deflator, the PCED. Likewise, from a high of about 7, we've come all the way down to 4.2 on our headline number. It's great to be back in the 4s. Remember, their target is a 2% number. And core, just like on the CPI side, is still being persistent and a little bit stickier. It's currently higher than where we're at when you subtract out both the food and energy piece. So that's the inflation front, a lot of progress. Just to comment to you, next month's CPI and PCED, we might actually have a bump up, so don't be shocked if that happens. And then we believe the next several months as we head into the summer should continue to be a downward trajectory. So what does this mean from an economic market perspective? We've shared this chart with you since last year. We said we are in at least a slowdown, and this is City National Rockdale putting odds on one of 3 scenarios. A slow growth, or what I would call a profit recession, that's definitely happening, and we'll touch on that in a minute, at a 24% odds, which means there's still some positive GDP growth, but earnings growth will be, under double digits, but maybe still above 0. A mild recession, their most likely case at 64%. By the way, that is what the Federal Reserve is targeting. History says that the Fed is very rarely gets that right when they apply the brakes to get off the brakes quick enough to merely have a slowdown or a mild recession, but that's their target. What that means is that is that slow landing, that we kind of come down to a 0 GDP, so to speak. And maybe there's a quarter or 2 that earnings are negative, and that's already happening. But this is the worst case, and it is our lowest odds case of a full-blown recession. So we are definitely in that slowdown mode, and we're tripping a bit lower. What's this really mean? Well, here we are, May 5th, and this is the update on the earnings per share, the EPS, as well as the revenue for the first quarter that's already out. And as we're recording this, 85% of all the S&P 500 companies have reported. And if we look, what is the year-over-year growth of earnings? Well, it was forecasted to come in not quite a 7% decline, 6.7, and we've done better. It is a decline. This will be the second quarter in a row that earnings have declined at a minus 2.2, but we had about 79% of the companies who have reported thus far actually with earnings surprises to the upside. Still negative, but less negative. So that's encouraging. And then likewise on a revenue basis year over year, the estimate was that we would be just barely positive, about a 1% revenue gain, and we've outperformed that too, 3.9. So like we said, GDP, fourth quarter, 2.7, decelerated. We had our initial look at first quarter GDP, came in at 1.1. We'll see how it gets revised. So we are slowing down. And then when it comes to the forward estimates on earnings, second quarter should be -2. That's the forecast. Hopefully we'll outperform it again. We'll see. But then by third quarter, and the estimates going forward are finally raising, going up rather than being marked down. But third quarter would be a positive earnings estimate, and then fourth quarter even stronger. So that's the lay of the land when it comes to the economy and earnings. Stay tuned to the next session where we'll talk about some of the risks that we're facing as we look into this scenario. Stay tuned.